What's going on, guys? Today we've got an amazing episode with Darius Dale, the founder and CEO of 42 Macro. We talk tariffs, what's going on with risk assets. Was it a mistake? What's going to happen next? And Darius, he lays it on. Is this the blue collar industry versus Wall Street? Who's going to win? We got it all covered today. Here's my latest conversation with Darius Dale. All right, Darius, I thought the best place to start is with the main show. The Super Bowl of all of capitalism is Main Street versus the blue collar businesses. This feels like all my friends in finance, they hate tariffs. They think this is the dumbest policy they've ever heard of. A lot of the people I know in the industrial manufacturing industry, they're pretty excited about it. There was a guy from Marlin Steel. He's a CEO. He was on the floor of the factory on CNN holding up a basket saying Trump is going to level the playing field. And he seemed really excited. What is going on here? Why are there two different factions?
Yeah, great question. And thanks for having me as always. Great to be here, especially during such a trying time. The reason there are two factions is because we were exiting a game, a paradigm whereby the winners of the game were people who most benefited from globalization and that geopolitical world order. And we're likely headed to a paradigm where the winners of the game are the people who benefit from more regionalized, localized, factors of production. And so that's why you see this sort of debate between Wall Street and Main Street, because Wall Street exists to find profits, to find productivity, and ultimately the best way that they figured out, quite possibly in history, was globalization, right? You basically reduce the largest cost of largest input cost for most production, which is labor. You found a way to spread those costs around the world and ultimately lower costs and create a significant positive shock to corporate profits. My favorite chart, which you guys will put up while we're talking, is the chart that shows labor versus capital. It has corporate profits as a share of gross domestic income up at 14% relative to a long-term mean data back to the 40s or 50s of about 9%. And then we have labor share of national income, which is somewhere around 51, 52% compared to a long-run mean of about 56, 57%. Now, the deviations from those means doesn't sound like a lot. It's like 500 basis points. But 500 basis points effectively, equates to about $1.5 trillion of lost income that's going from the household sector to corporate profits every year. That's about, let's call it 11% of the median, 13% of the median income. And it's roughly about, $11,000 per private sector employee. So basically every American household with two working people is losing about $25,000 a year as a function of globalization. And that's why the entire electoral college map was red from sea to shining sea.
Now, I agree with that. And I think that Wall Street doesn't understand it. I, for a whole different reason, have spent the last 2 years talking to a lot of people in the industrial manufacturing space. I've gone to these businesses. I've walked the factory floors. I've met the workers. I've met the CEOs, all this stuff. These people do not care if your Wall Street portfolio is going down. And people say, oh, they're 401k, all this stuff. Listen, the people who are working in these businesses, I'm not talking about the CEO who's got stocks and stuff like that. I'm talking about the people. I went to a electrical harness business in Michigan. And there's a bunch of people, and they were literally assembling electrical harnesses that go into cars and different electrical products, right? These people are sitting there assembling these products with their podcast or their music playing in their headphones. They're doing it all day long. They don't even know the stock market is going down. No. They're trying to go to work, make a living, go home, enjoy their life, and make a better life for their kids than they had for themselves. That's their goal. And so the investors, though, they do have investments. They do care about the stock market. I knew that this was going to be a very important chart because I have never seen you draw on a chart before. And when I saw the drawing, I said, my boy was in the lab cooking. So before we put this chart up, I want everyone to take that wax out of your ears, put your glasses on. If you got rec specs, with the elastic band for sports, put the rec specs on. Darius, hit us with what's going on in the risk asset chart you got here.
Yeah, look, man, thank you for saying all that, man. And by the way, I agree with you. You and I both have very humble beginnings to where we've gone to today. I think you and I understand the plight of the common man, of the folks who've been left behind by globalization, much more saliently and much more real, tangibly than the average person on Wall Street, the coastal elites who comprise Wall Street and Palm Beach and San Francisco and all the stuff that's going on in Hollywood. At the end of the day, what we're trying to do is educate them as to why President Trump feels so compelled to stick with this fourth turning transition. And so that takes me right to this chart here, which is when you think about how markets behave in a quote unquote normal regime, a non-fourth turning regime where we have these massive, huge geopolitical, social, institutional changes, in a normal regime, you just have, your kind of standard bull marketed stocks. They go up, they go down as a function of the business cycle, and that's pretty much it. When we're in a fourth turning regime, you have all these very powerful forces pulling and pushing on each other, much like a sumo wrestler or offensive or defensive lineman in the trenches. There's so much force that, when the tide changes even a little bit, you have these massive melt ups and meltdowns in markets. Can I throw a stat at you, Pomp? That's going to, I'm going to throw two stats at you. One's going to shock you to your core. The first one won't, but the second one definitely will. The first one is every year since 2015, the market has either gone down 20% or up 20% in that calendar year. We've been living in a nuts timeline, right? Every year for the past decade, the market has either gone down 20% inch a year or up 20% inch a year. Like that's more than double what a normal market return is. And that's what we're trying to suggest is that the fiscal largesse that you tend to see as a function of populism in a fourth turning, as well as the monetary policy response to that in terms of, gobbling up bonds and trying to, force financial repression onto investors. These are the kinds of dynamics that basically cause us to go from up 20 2 years in a row to down 20 the next year, maybe up 20 a couple years in a row to down 30 or 40 the next year. This kind of very volatile setup is a function of the fourth turning and all those dynamics. And one thing I'll conclude with, go back to the folks in that manufacturing plant in Michigan that are, just trying to provide a better life for themselves and their kids and hopefully that their kids can live a better life than they did. Those people definitely don't own stocks. Did you know, Pomp, that 88% of all financial assets in this country is owned by the top quintile of investors?
It's crazy.
The top 20% of human beings, of households in America, own 88% of all financial assets. That means the other 12%, we got to divide that with the 80% of us have to divide the other 12%. And so no wonder no one gives a damn about if the stock market's down because of tariffs. This is a real institutional societal shift transformation that's happening, and Wall Street is incentivized not to report it. They're incentivized to fight it. And ultimately, they're incentivized to lose money because of it, because ultimately they have to lose the game in paradigm A to facilitate the transition to paradigm B.
It makes a ton of sense. You've got a slide in here talking about the journey is more important than the destination. What's that mean?
Yeah, 100%. So this one of my favorite charts I've ever created in my almost 17-year career on Global Wall Street now. This chart helps explain what I think is the most misunderstood but very important, one of the most important concepts in all of finance. The average retail investor does not understand this chart, but everyone feels this chart, especially as you get older in life. So what this chart is essentially explains the impact that volatility drag has on investor portfolios. And volatility drag is, if you look at the far right of the chart where it shows portfolio size after year 3, look at the bars. There's $338 in the blue bar and $200 in the red bar. Volatility drag is the spread between those two bars, or essentially it's the spread between those two bars as a function of the path that the assets have taken to get there. Both the red bars and the blue bars in this chart feature identical 50% average annual returns. However, you wind up with more money if you take the path that the blue bar takes, which is a more smooth ride to building wealth, as opposed to a more volatile ride for building wealth. And this is what we try to coach investors on, is that you can build wealth by participating in assets like Bitcoin. I'm a huge Bitcoiner. You're obviously a Bitcoiner. But you also need to be respectful of the fact that if you buy the asset or are overly exposed to the asset at the wrong time in the investment cycle, you will suffer volatility drag and you'll ultimately wind up with less money over a longer period, over a longer time horizon. So I think 2025 is a great year to reintroduce investors to this very important concept. Now,
asset prices are crashing and inflation was crashing. If you look at things like Trueflation, the Fed emergency rate cut odds are up like 25 to 30%. But you're saying, which still means there's not likely to do it. People forget how odds work.
What's 25 basis points going to do, Pomp? Come on.
The labor market, though, you think is too robust. You think that they can't cut. Explain.
This is the problem. This has always been the problem with the Fed. They anchor on lagging indicators. The Fed only eases policy for 3 reasons. One, we have a miraculous disinflation, which almost never happens in the history of the data. So you can kind of rule that out, especially in the context of, going back to before Smoot-Hawley and tariff prices and tariff tax rates. Two, the labor market comes unglued, which the labor market is a lagging indicator. It lags the economy and the stock market by about 2 quarters. So it's too late if they're going to do that then as a function of labor market. And then there's financial stability concerns, which of course it'll be too late in market price terms, may not be too late in labor market terms. They eased policy in September of 2019 in response to financial stability concerns, and it prevented what may have prevented a recession. We wouldn't know. Obviously, COVID is a kind of factual, but it may have prevented a recession then. But the reality is we had already crashed in Q4 18 and the credit market froze up. So the reality is the Fed is I think I talked about this a few years ago in 2022, which is the Fed's like a janitor, right? Like you don't see a janitor like sweeping the mop and broom over people's shoes when they're working or partying at the event. The Fed comes in after with all the trash on the floor and sweeps it into the dustpan and mops the floor, right? And so ultimately, as an investor, you need to be aware that, you can't be so myopically focused on the Fed to bail you out because they're usually going to be too late, is what I'm essentially trying to say. And right now, the labor market is too robust, as evidenced by non-farm payrolls growing 345,000 since Trump took office. I mean, this is a labor market. I mean, granted, you can take issue with this data, and I do take issue with this data to some degree. But even when you look at hyper high frequency data like jobless claims or some of the Indeed survey data or leading soft data, it still says that the labor market is still reasonably robust. And that's a problem for investors.
Now, the Fed, what can they do? Obviously, they're not going to cut. What are they? You and I have talked before. Are they going to raise the inflation target? Or are they potentially just going to say, screw it, we messed up? They're behind the ball. They're lost in the sauce, right? Frankly, what do you do? Look. Jerome Powell's just like, I'm not going to listen to Trump. Trump's tweeting at him. What happens?
Yeah, look, I think this is why you play nice in the sandbox. And Trump's going to regret being so mean to Jay Powell over the past, 6, 7, 8 years. Jay Powell, if he was on board, would probably have already cut interest rates and probably have already signaled, hey, we are prepared to use our balance sheet to tone down volatility in financial markets. That's what a good I'm not even saying Jay Powell's a good or bad central banker, but I think a proactive central banker would be doing that by now, because they ultimately understand that whenever you have contractionary fiscal policy, in order to keep an equilibrium level of economic activity, you need to have equally expansionary monetary policy. And they're doing the exact opposite of that in terms of sitting on their hands and maintaining what they believe is a restrictive monetary policy setting. That's wrong, in my opinion. And you and I have talked about this slide here, our secular inflation model slide, many times over the past few years, which is our model continues to suggest that the equilibrium core PCE inflation rate in the U.S. economy is around 3%. Somewhere in the high 2s, low 3s, can't be more specific than that. But the Fed is targeting a 2% inflation target. And as long as they're targeting a 2% inflation target, that means they're sort of forced to sit on their hands and keep monetary policy, at least according to their metrics, restrictive until they feel very confident that inflation is going to return to 2%. And based on our model, if the equilibrium inflation rate is 3% or somewhere thereabouts, then the only way you're going to feel very confident about that is in a significant breakdown in the labor market. And what I'm trying to argue is if they just acknowledge the fact that the inflation is running hotter in this business cycle, we wouldn't have to suffer through all that needless job loss as a function of the policy mistake they're currently making.
Do you think that they can get back on the ball? Like, is it possible for them to catch up? Today's episode is brought to you by Consensus. They're the world's longest running and most influential gathering of the global crypto, blockchain, and AI communities. Curated by CoinDesk, this prestigious annual event happens in Toronto, Canada on May 14th through the 16th, and it is set to welcome 20,000 builders, investors, policymakers, and pioneers shaping the future of the decentralized digital economy. From understanding Bitcoin's potential in a shifting regulatory landscape to the latest innovations in the digital assets and infrastructure, Consensus is your best bet to unlock market-moving intel, make meaningful connections, and get business done. You can't afford to miss it. And because you listen to this podcast and you watch this show, you get 15% off registration if you use the code POMP15. Go to CoindeskPomp.com. Again, that's CoindeskPomp.com to register now. Once again, go to CoindeskPomp.com and use code POMP15 for 15% off your Consensus Toronto tickets today. It's no secret that Bitcoin ETFs have taken Wall Street by storm. With over $35 billion in assets in just 1 year, it's become the most successful ETF launch in history. My partner Bitwise is the first and only Bitcoin ETF provider to openly publish its Bitcoin wallet addresses, allowing anyone to verify the fund's holdings. I believe this level of transparency is exactly the kind of innovation that only crypto makes possible. Bitwise is also the only ETF issuer that is a crypto specialist asset manager, meaning their team solely focuses on Bitcoin, and they have the research, education, and support to help investors navigate the space with confidence. All of that is great, but what I love most about Bitwise is probably their commitment to developers. Bitwise donates 10% of their ETF's profits to Bitcoin open source developers. Bitcoin developers are the unsung heroes, working tirelessly to maintain, improve, and innovate the blockchain. Their efforts ensure that Bitcoin remains true to its promise as a decentralized system that is built to last. Go to bitwisepomp.com to learn more about their ETF and other services. Once again, that's bitwisepomp.com. bitwisepomp.com. As always, remember investing is risky and carefully consider the extreme risks associated with crypto before you invest. Do you think that they can get back on the ball? Like, is it possible for them to catch up?
Is it possible? Yeah. So yes, but they've already kind of hinted that they're not going to. So they have a monetary policy review this year. Every 5 years, the Federal Reserve conducts a deep dive study on what they got right, what they got wrong, what they might need to change about their entire policy framework. And what's conspicuously missing from that monetary policy review is the 2% inflation target. Don't forget, Pomp, we got that thing from some random central banker in New Zealand. Like, why are we managing the world?
No, dude, I heard it's part of the 10 Commandments. It's part of the 10 Commandments, obviously.
Totally. I would prefer it to come from the 10 Commandments. As a Christian man, I would much prefer Moses have come from Mount Sinai and said inflation needs to be 2% or else than some random guy in New Zealand. Nobody even knows his name, right? The Federal Reserve is making a monetary policy mistake that's going to cost investors trillions of capital destroyed in the stock market and crypto market crashes. And also millions of people are likely to be put out of work as a function of their inability to get, to acknowledge the changes in the economy that our model has been signaling since January of 2022, and just accept the fact that we're running a hotter inflation economy. If it's 3%, then you can start easing a lot sooner, which could potentially offset this fiscal contraction that we're hitting. And by the way, fiscal contraction is a big deal. We're talking tariffs, right? Everybody can see tariffs. I mean, you just take your head out of the sand and see tariffs. You can go to your local downtown. There's probably people protesting. But people have already forgotten that Doge is aiming to take $1 trillion out of annual federal expenditures. Now, you and I very much agree that Doge is a necessary, painful medicine that this economy needs to take to prevent a fiscal crisis. But again, emphasis on painful medicine. If you try to do it, it's going to hurt. And it may, in fact, create trigger a technical recession, if not an actual recession, when combined with the net impacts of tariffs.
You had this thesis called the kitchen sink thesis. What's the latest on that?
Yeah. The latest is that Wall Street is they're still washing their hands. Like, President Trump yanked the sink out of the wall and is like walking out of the office with the sink, right? Wall Street is still standing there over what used to be a sink, rubbing their hands with soapy, with their hands doused in soap. They don't realize that everything you and I have been talking about with respect to this transition from paradigm A to paradigm B, how the globalists and the corporate fat cats in Wall Street have to lose in order for those folks on that factory line in Michigan to finally start winning again. They don't realize this, and they're very reluctant to take down their estimates to acknowledge this. And part of it, right, I don't think they're incentivized to say where we're going, right? Like, because it's saying, hey, I have to lose, right? Nobody's incentivized to raise their hand and say, we have to make a lot less profits going forward in order to make the American worker happy, right? Because that's where we're going, right? If President Trump and his Trump administration can stay the course with respect to their policy path, and they may or may not be, I'm not even making an argument about that, but if this is where we're going, then ultimately the numbers on this chart have to go down. What we're showing here, S&P 500 index sales estimates with respect to the broader index technology sector and then X technology. As you can see on the chart on the left, there's a linear acceleration in revenue growth projected as of today for S&P 500 companies, both technology and X technology, from the low in Q1 2025 all the way through high to 2026. How in the world is revenue growth going to accelerate from 4% to 7% over the next 4 quarters in the context of everything we can already just see on the tape without having to do any empirical or econometric analysis? Moreover, we have this back half of the year hockey stick projected where you got earnings growth accelerating from about 7% to 11, 12% in the back half of the year. At the same time, the economy could very well be in a technical and or actual recession at that point in time. And so to me, I continue to see a great deal of resistance among my colleagues across global Wall Street in acknowledging this fourth turning transition from paradigm A to paradigm B. And ultimately, that reluctance, in my opinion, insulates the down. It doesn't insulate. It accelerates the downside in asset markets. Markets are not going to be able to bottom until we have a serious conversation about what the economy is going to look like 2 to 3 quarters from now and how we can start to build up from that base. But we got to actually have a serious conversation about that.
The Republican Party, one of the promises they've made is they want to make a big tax cut, but not for the rich. They want to do it for people making $150,000 or less. Sounds great. A lot of people will be very happy. I don't think they're going to be able to cut federal income tax level to zero, but I do think that they can have a cut. But it would be backstopped or paid for with debt is kind of the plan. Describe a little bit as to what this plan is. And does that just mean like all assets go up if we're going to keep on taking debt?
Well, that's a phenomenal question, Pomp. As always, you know, you're one of the best in the world at this. They're going to, the Trump administration will tell you that it's not going to be financed with debt, by the way. They'll say the tariff revenue's coming. We have tax spending cuts offsetting that in terms of what they're likely to legislate, at least with respect to the House bill. That's the table on the left there in that chart. And then they have the tariff revenue, the spending cuts, and the DOGE cuts. They think this is all going to wind up with lower deficits over the long term. I take great offense to that. We've done a tremendous amount of econometric analysis, analyzing, all these relevant time series to demonstrate that there's been never in history has there been an administration that, certainly not in the post-war U.S. economy, that has paid down the debt and grown its way out of the debt. So we don't think we're going to start now, especially with our starting point of a positive output gap, one part of my 1.6%. Recall that the output gap was minus 0.3% when they launched the first TCJA, and we got a positive shock to growth then that ultimately wound up with still the deficit declining, getting worse. It went from minus 3% in 2017 to minus 4% in 2018 to minus 5% in 2019. So we had deficit expansion then with a negative output gap. With the positive output gap plus tariffs plus DOGE plus a Fed that has got a too tight monetary policy setting for everything that's happening from a fiscal policy setting, I don't see how you don't want to expand the deficit, but that's neither here nor there. On the right side of this table, we show the Senate plan. The Senate plan essentially is you're going to use this, what we call this current policy baseline, which assumes the cost of extending the Trump tax cuts does not cost anything, which allows them to dump a bunch of extra goodies onto the bill, like no tax on tips, no tax on Social Security, et cetera. That would be very debt financed. They're not calling for much of at all a deficit reduction in terms of spending cuts. So ultimately, you're talking about a potential net debt growth of about $7 trillion if the Senate, kind of won this debate. It's unclear to me if Trump will have the political cachet as he currently does now in order to sort of whip the House Republicans in to get them the fiscal hawks down in the House in line with what he wants, because he supports the Senate bill. But we'll see. But the reality is, we're not going to grow our way out of it. They're going to tell us they're going to grow our way out of it, and ultimately we're going to wind up with a lot of debt, a lot more debt.
Do you think the tariffs were a mistake?
Do I think tariffs are a mistake? No, I don't think the tariffs are a mistake because I support the transition from paradigm A, which is a K-shaped, top-heavy economy, that is, built up top fiscal largesse, but most importantly, built atop very regressive fiscal largesse. We have a 25% government expenditure to GDP ratio. Clearly, it's not going to the people who turn the entire electoral college red from C to signing C. It's going to the rich people who've been scamming the government. I mean, I know people personally that took PPP money and bought private jets with it, right? This is where the fiscal largesse has gone. It's to the top part of the K, to the asset owners, to that very narrowly concentrated subset of the United States society that has been, eating high and living high on the hog at everyone else's expense. And so, yes, I do support this transition from paradigm A, which is that, to paradigm B, which is this more egalitarian E-shaped economy where everyone, the upper class, the middle class, the lower class, I don't know if you can say class anymore. I don't have time to be politically correct now, but everyone is just rowing the boat in the same direction, whether it be up or down, as opposed to the K where the winners win and the losers lose. I very much support that as someone who grew up very poor and on the outside looking in and very supportive and sympathetic to the cause of Main Street. Do I support the way they are implemented with, quite frankly, Fisher-Price math? No. Do I support the order in which they were implemented And, you can't really fault them for the order because they only have about a year to get this stuff done, because we know Congress is going to flip hands again. It flips hands every single midterm election and has done that for like a decade. So we know he has a very narrow window to get his policy priorities enacted. And so I would have launched the tax cut and deregulation program simultaneously with this, see how we shook out in terms of negotiating the deals, then layer Doge on top of that in order to hit a negative shock to the demand for capital in the economy. At the same time, you're asking everybody to build factories here. That's the order of operations that I would have chosen, but I don't know if you can do that in the context of the midterms.
Darius, where can we send people to find you?
Oh, I appreciate you, man. Thanks again for having me, man. I love catching up with you, brother. 42macro.com. Come check us out. Everything we talk about is very helpful for investors, but the number one thing we do for our investors is time markets with systematic quantitative risk management overlays. So 42macro.com, come check those out. And then you can find me on Darius Dale 42 on Twitter, where I kind of talk about all this fundamental stuff. I call it fundamental stuff because at the end of the day, the
best on Wall Street. The best on Wall Street. That's what I tell people.
I don't know about it. And I'm definitely not the best. I'm definitely I'm working hard to become the best. And I think we've done a really good job for our clients this year. Did a really good job for our clients last year. Did a really good job for our clients in 2023. Did a really good job for our clients in 2022. Did a really good job for our clients in 2021 when we launched the firm. So that's 4 years in a row of doing a fantastic job for our clients. And we fully expect to continue that run.
I love it, man. Thank you so much. We'll do it again soon.
Appreciate you, brother.